Welcome to Accounting with Madam Ombi. Today, we are going to look at accounting for manufacturing firms or accounting for manufacturing organizations. To begin with, we are going to define what are manufacturing firms. And simply, from the word manufacturing, these are organizations that convert raw materials into finished goods. They then sell those finished goods in the market to earn a profit. This form of businesses could either be a sole proprietor running a manufacturing organization. It would also be a partnership where two partners have come together or more to form a business that is dealing with manufacturing. It would also be a company. So a manufacturing organization, that is why we're just calling them firms, not specifically company, partnership, or sole proprietorship, because it will take any form of business. We are going to start by defining some terminologies that we are going to be using as we compute the issues that regards manufacturing statement. The first terminology is direct material. Now, from the word direct, it means it is directly associated to something. So in our case here, direct material, there are those material costs that can be traced in the final product in an economically feasible way. These are material costs that are variable and they are directly associated with production. The more the production, the more the material cost, or the direct material cost in this case. So direct material costs are variable costs. They vary directly in proportion to the production. The next terminology is direct labor. This is the effort of a factory worker that can be traced in the final product, or the effort of a factory worker that can directly be associated or attributed to production. Again, all direct costs are variable costs. Therefore, direct labor is also a variable cost. It directly varies with production. The more the production, the more direct labor is incurred. The other terminology is direct expense. Direct expense, these are other costs other than material and labor that are directly or exclusively incurred in relation to production. We are going to see some direct expenses like royalties. It would be some of the direct expenses. Cost of hiring probably a specific skill or a machine that was specifically hired because of production. Those would amount to direct cost. Also, as we have said, these are variable costs. When you add the first three terminologies, or when you add the three costs, that is direct material, direct labor, and direct expense, what you get is called prime cost. Prime meaning fundamental, most important cost. So when you're manufacturing, the most important cost is the three of them, which is direct material, direct labor, and direct expenses. Now, another terminology is manufacturing overheads, or simply overheads, or factory overheads. These are all the indirect costs. The indirect costs would be indirect material. It would also be indirect labor. For example, if you are in a production department and there is a supervisor who is overseeing the work being done, or who is overseeing the production of certain commodity, the salary to that supervisor is an indirect labor cost, because he is not directly involved in production, but he is overseeing the production. Therefore, his cost is an overhead. So indirect labor, I'm giving here foreman, wages, supervisors, salaries. Those are indirect labor costs. Other indirect expenses are factory power, factory heating, lighting, insurance, and then depreciation of plant and machinery. These are all costs that cannot directly be attributed to production of a specific unit, but were incurred in the factory. So we are going to Move on, the next terminology is work in progress. From what the word suggests, work in progress, these are cost of units that have remained incomplete at the end of an accounting period. So if the accounting period is over, we'll have a closing work in progress. We'll also have, for the next period, of course, it will be the opening work in progress. So it is good to note that at the end of the accounting period, opening work in progress is added to the manufacturing costs in assumption that those units that were incomplete at the beginning of the period were completed during the year. For example, assuming that organization is using first in, first out in production so that any item of opening stock will not find its way to the closing stock. So opening work in progress is added to the manufacturing cost, while closing work in progress is subtracted from the manufacturing cost at the end of the accounting period. We are also going to familiarize ourselves with one terminology here, that is unrealized profit. Now this will be much better explained when we look at our question, but unrealized profit occurs whereby, in case during production we add a markup or what we call a factory profit. That would mean that if any item among the ones to which we have added a factory profit is still in the stock, meaning there is closing stock and opening stock, those closing stocks and opening stocks are overpriced by the amount of the markup. So that amount of markup is what you're calling unrealized profits. And allow me to show you this later in the question on how we do the adjustments, but simply we are going to be following the prudence concept to ensure that profit is not overstated, neither are the assets in the balance sheet. They are not overstated by this, what we are calling the unrealized profit. So to move on, manufacturers or these organizations, manufacturing firms, they have to prepare 3 accounts. One of them is the manufacturing statement. The other one is the income statement. And then they finally have to prepare the statement of financial position. So we are going to start with the manufacturing statement. A manufacturing statement is prepared to show the cost of production. So simply, it is an addition of all the costs incurred in production, beginning with direct materials. So for direct materials, we are going to start with the opening stock of raw materials. How much materials were purchased during the period? If those materials were carried at a cost, there will be a cost of carriage inward, which we are going to add to the cost of raw materials. And if any of them were returned, then the returns are also going to be less. So this will give us the cost of raw materials available for use. And we have to less closing stock of raw materials to be able to get the cost of raw materials used. So all that is going to give us direct material costs, after which we are going to add the direct labor, the direct expenses. We get prime costs, we add to the factory overhead. That is all the indirect costs, as we have mentioned earlier, from which we get the manufacturing cost. Finally, we add opening work in progress and less closing work in progress to get the cost of completed goods. It is not a must that every organization has a policy to include a factory profit, but if there is a factory profit, then it is computed as a percentage of the cost of completed goods to get the cost of goods completed and transferred. That is the first statement that we are going to prepare, the manufacturing statement. The next one is the trading profit and loss account. This is prepared the same way as that of a sole trader. It is simply a statement that shows whether the company is making a profit or a loss from the operations. The only difference here is going to be that while in other organizations they purchase items and sell, in a manufacturing organization they produce the goods and sell them. So in the place of purchases on the cost of sales, we are going to replace purchases as ordinarily would be for other trading organizations, and we are going to replace them with the cost of goods completed and transferred. So a trading profit and loss account begins by identifying the sales, how much was sold, and adjusting that for any returns in case there were any customers who returned the goods. Then we get the net sales. We get also the cost of those sales in terms of the cost of goods sold. This time we are talking about the finished goods. Once we get the cost of sales, we subtract from the net sales to get the gross profit. Another item that we have to add here, which is peculiar to manufacturing organizations, is the manufacturing profit. So from what we had from the manufacturing statement, if the company has a policy of adding a manufacturing profit, then we have to add it also here to the trading profit and loss account. We also list all the expenses. The expenses that we bring to the trading account are going to be the administrative expenses, such as staff salaries, office printing, office lighting. We're also going to look at selling and distribution costs, like depreciation of motor vehicles that are used in selling, salesmen salaries, commissions, advertising. We're also going to look at financial expenses such as bank charges, interest on loans. These are the ones we're going to include here. All the expenses that relate to administration, selling, finance, distribution, and so on. Then we are going to adjust the net profit for what we call unrealized profit, that is resulting from what we have discussed there as a factory profit. The next item we are going to prepare, or the next account we are going to prepare, is a statement of the financial position. Again, this one is also prepared the same way as that of a sole trader. The only difference being that here the current assets are more. In the place of stock, there will be 3 types of stock. That is the raw materials, the work in progress, and the finished goods. And for the finished goods, we are also going to adjust for unrealized profit, as we are going to see in our question in a few minutes. And the provision, and the debtors, we are also going to adjust for provision for doubtful debts. Since we said a manufacturing organization would be in any form, it would be a sole proprietorship, a company, a partnership. The finance by section will be determined by the form of business. So simply what I've put here is that in the finance by, you're going to have equity, that is capital adjusted for drawings, and then you're going to have non-current liabilities such as loans and debentures. So the financing by of a manufacturing organization is going to be dependent on the form of the business that the firm undertakes. So for us to be able to achieve all this, we are going to look at our question here. So our question says the following balances have been extracted from the books of Royal Manufacturers, a small-scale manufacturing enterprise, as at 31st December 2021. So to begin with, you have their stock as at 1st January, raw materials, work in progress, and finished goods. You have purchases of raw materials, direct labor, direct expense, factory insurance. All the way down, we can see all those balances. And then we have the additional information, which is the closing stock as at 31st December 2021 of raw materials, again, work in progress, and finished goods. And you have the factory output is transferred to the trading account at factory cost and 25% factory profit. This is what we have called the manufacturing profit. Then depreciation there, it is charged at the respective rates, and there is an accrual and a prepayment on additional information number 4. So this question is what is going to help us to understand better on how to prepare the statements required by a manufacturing organization. And I hope that you take a copy of the question so that we can proceed to answer.